I am so excited. We've got Mr. Mark Willis on our program this afternoon, for those of you that are on the East Coast. And Mark is a certified financial planner, but so much more. I mean, just talking to him a little bit before the session, I know he's a best-selling author, and he's really helping coach people and help people in so many different areas of getting their financial house in order, but also helping clients move towards wealth building. And so welcome to the program, Mark.
Oh, thanks so much. I appreciate you having me on.
Yeah, absolutely. So Mark, just so our audience can kind of get to know you a little bit, kind of walk us through your background, tell us your backstory.
Well, I didn't graduate with finance as my degree. I did graduate with debt as my degree. That's for sure. My wife and I jokingly say I married two women in college. My beautiful wife and Sally Mae, who was along for the ride. So we found very quickly that she needed money every month and was not going away anytime soon. So we graduated in the midst of 2008, where there wasn't plentiful jobs available, and there was a lot of fear and loathing happening at that time in the markets. And yet, I was getting more and more focused on my own finances. That was sort of, unexpected outcome of the market's crash, is that a lot more people got focused on their finances, which was a positive, I guess. Yeah. And somewhere along the way, I kind of woke up. It was really, I credit my wife for this, kind of woke up from the employee mindset and started to become more entrepreneurial minded. I think you look at most kids anyway, they're entrepreneurs from the cradle, you know, whether it's a lemonade stand or selling comic books or whatever, they're out there making it happen. And I guess something kind of beautiful awoke inside me, and as a result, my wife and I started a financial firm to help teach others, clients of ours, some of the strategies that we had found along the way of becoming not just debt-free, but better than debt-free. Wow. So that's what we specialize in, helping business owners, like many of those listening to the show today, to help them not only become solvent financially, but to become what others have called anti-fragile with your money. Not just strong or resilient, but literally thriving in the midst of chaos. That's what anti-fragile is all about. And so that's what we help business owners achieve.
I love it. And, with real estate brokers, we are all independent contractors. So we are all, by definition, entrepreneurs, business owners. And I love this concept of being anti-fragile, because it does feel like for a lot of real estate agents that they're kind of always on this precipice of disaster, so to speak, and they're just kind of right on the fine line of being able to pay their bills and so forth. So let's walk through some of your coaching. Like, how do you help people, and what is your kind of message and your theme of your coaching?
Well, there's specific strategies we can get into today, Jim, if you'd like.
Yeah, absolutely.
But in principle, especially in the last 90 to 120 days or so, last 3 or 4 months, I've really seen the value of talking about our finances the same way we've all been talking about this terrible virus that's swept across our land. And my prayers and my heart goes out to anybody who's been either medically or financially impacted by this terrible coronavirus. And my hope is that 6 months, 3 months, whatever from now, we're all back to some new normal. But we can also vaccinate our money. And I want to talk about what that looks like, specifically for the business owner, if you don't mind, Jim, just for a minute.
Dive in.
Now, when you're sick, you need a couple of things to help you get better. And I would say that's the same with our money, but let me kind of explain. So when I get sick with the flu or whatever, first thing I need fluids. I need fluids. And I would say, we need to drink lots of water to keep our body fighting strong. And when our money is sick, we need ready access to capital where we can fight back. We need liquidity with our cash. And I think too many people entered into this coronavirus. We didn't have enough money to cover a flat tire. And what we got was a terrible torrential downpour on us, financially speaking. So we need a lot more money in liquid, accessible cash. And that doesn't mean we have to give up growth. It just means we need to be ready, both for emergencies, also for opportunities. If you're a real estate agent or broker and you see an opportunity to buy up a bunch of, I don't know, direct mail or, online ads or some other opportunity to really grow your presence in the marketplace, it's going to be the people with cash to take advantage of that when everyone else is running scared. When you're looking as a real estate investor, if no one else is buying that 4-unit down the street, what happens to the price? Well, it goes down. And if you're the person that has ready access to fluid capital cash, you can really take advantage of, the situation that you're in. That's one way to be anti-fragile, where in the bad times you actually thrive.
How do you do that?
Yeah.
So how do you make that happen, Mark?
Well, it's in many ways, it goes back to grandma. Grandma was pretty good at telling us to save for a rainy day. And like I said, we got a torrential downpour this year. But it really is a matter of saying, all right, I'm going to be bucking the trend. I'm going to be a little different than the average financial media asks us to save. What is it? 3 months of our expenses. What if you had 2 years of OpEx ready to go? Not just sitting idle and on the sidelines, but ready to pounce when the right moment arose. So we're not just talking about living in fear. I'm saying be ready to be aggressive. What's Warren Buffett say? Be fearful when others are greedy and greedy when others are fearful.
I just used that this morning. That's a great quote.
Did you? Yeah. So that's the first. There's actually 4 ways to antivirus your money. The second, or to vaccinate your money. The first is you need fluids. The second is you need to quarantine. So what I mean by that is put your money in non-correlated assets. Big $2 cocktail term there, Jim.
Yeah.
Basically what I mean by that is have some money that's not riding the same truck. Many average financial advisors will tell you, get your money in 12 different mutual funds, growth stock, value invest, emerging markets and the rest. And that's fine. But if all of those baskets of eggs are on the same truck and that truck goes over a cliff, what good did all that diversification do? So the key is you need to quarantine some of your cash off of that truck, get it off of that asset class of stocks and into a non-correlated, meaning not the same or not riding on the same rails as your other money. Non-correlated assets. Get it in quarantine. That's the second step. Third step, antibodies. Antibodies. We want things that we can actually grow with or actually get better with. If you can see something that builds your immunity, you're actually learning. It's like your body, whenever you get an antibody, it's like your body learns something new. And so you want to have something that can get better under pressure. And this is that anti-fragile idea that we've been talking about.
Sure.
When you've got a antibody in your system, you're actually now stronger. You face a threat. It's a weak threat, but when you're inoculated with a vaccine, you're actually most of the time receiving sort of a weak form or a dead virus in your body, and your body has to summon its immune system to activate itself to respond and wipe that virus out. And the same is true with our money. If we have small workouts for our money where we get it working and put it to use and actually help it grow in the midst of downturns, we want something that grows in the midst of downturns. That's a way to help your money actually become more resilient in the downturns that very likely will continue to experience.
Yeah, I mean, I think we're all living in a different, definitely a chaotic world. So I think people can appreciate what you're saying and preparing for chaos and being, just in the midst of it and understanding it. That's powerful.
We've had 3 major market crashes just since the year 2000. Jim, do you think we're done with volatility now?
No, not at all.
So, and then the last of all of these is we need supplements. When your body is sick, you need supplements. Well, what I mean by that is you really need to find a way for your money not to fight itself. When you've got your 401k earning 8% pre-tax this year, non-guaranteed, and yet you've got a third of your revenue going to servicing low interest debt, even if it's low interest, let's say you've got a 3% mortgage and a 2% student loan and a 1% car loan and another 1% car loan, and you start adding all that up, that's like the average American spends about 35% of his or her income on servicing debt.
Wow. Incredible.
According to the U.S. Commerce Bureau.
Mm-hmm.
And so that's a third of our day, guys. That's a third of our day, Jim, that's gone to being a slave to the bank.
Yeah. Incredible.
So I don't care what your 401k did last year, non-guaranteed. If you've got a guaranteed 1/3 of your income going straight to a bank, you're going to lose.
You're going to lose.
That's why so many businesses go under, for unfortunately so.
With that in mind, is a big mission of what you coach people on is getting that debt all paid off?
Well, there's different ways to pay off the debt. Certainly debt, when banks control the environment where your money lives, they're going to win.
Mm-hmm.
But if you control the environment where your money lives, you'll win every time. Mm-hmm. So I'd like to actually frame the conversation a little bit different, Jim. Debt isn't the problem. Banking, there's a great book out there by David Graeber. The book is called Debt, the First 5,000 Years. Right? So debt is as old as human civilization. And I don't think it's going anywhere. And you look at some of these mega banks downtown in your city, it's usually the biggest building in town.
Yep.
I don't think banking is the problem.
Mm-hmm.
I think we just have the wrong person behind the banker's desk. And so if we could find a way, not just to be debt free, but actually to become our own source of financing, that I believe is the ticket to real financial freedom. It's the small hinge that swings the big door. If you could be your own banker, if you could bank on yourself, then all of a sudden you don't have to worry about what banks are doing in the midst of a downturn. There's a great quote by Mark Twain. He says, a banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain.
It's a great quote. I love Twain.
So if we could become our own banker, I feel like all of a sudden, everything else, it's the old focusing question. If you could become your own source of financing, everything else in your financial life either becomes easier or unnecessary.
What's the roadmap for doing that? How do you make that happen?
Yeah, well, there's kind of two ways to do it.
Okay.
Either you scratch together $10 million and you go open a FDIC insured bank down the
a little bit of a struggle, a little bit of a leap for most of us.
Yeah, at least for most of us. Yeah, me too. But another way to do it kind of is counterintuitive. And if you'll allow me, I'll kind of talk through this. So
sure.
Again, my wife and I had all this debt. We were trying to find the right way to pay it off. And we were really crushing it. We were following Dave Ramsey's snowball method and throwing all this money at our debt. We were trying to start a business at the same time. It was getting really hairy. And we woke up one day and with the help of a good friend, and he kind of opened my eyes to realize that every dollar I pay on my debt or a car or anything else we pay cash for, we're truly financing everything we buy, even when we pay cash, because either we pay interest to a bank or we pass up interest we could have earned on the money had we left it invested.
Sure.
And that was the aha, moment for me when I realized that you finance everything you buy. Either you pay interest or you pass up interest you could have earned. So
interesting thought. Okay.
So for me, that was the kind of moment when I said, well, I can't just throw all this money into a debt hole. I was in my mid-20s at the time, and those were valuable dollars. When you're in your 20s, that's a more valuable dollar than when you're in your 70s,
Right.
So that was really when we started doing some due diligence and did some research, and it took me a good 7 months of just trying to wrap my mind around it. I ended up getting a CFP, just trying to find some of the solutions that would maybe help me overcome the concept there is opportunity cost. The opportunity cost of paying cash for something. And one of the other ways, besides that FDIC insured $10 million bank route, is to really become your own source of financing. There's an old tool that's been around about 200 years. It's a dividend paying whole life insurance policy of all things. And to me, it was the last thing on my mind to look at whole life insurance of all things for my business or for my family. But the more I looked into it, the more compelling it became. I'll give you 4 really quick things that caught my attention. Whole life insurance, not the kind our grandparents had, But more modernized, high cash value life insurance policies have big buckets of contingency capital that we can use as an asset on our balance sheet for our family or our business. So if I've got a massive amount of capital inside the policy, it's liquid money. So back to having liquids. That's the first piece. I have ready access to it with no penalties and no taxes due. It's kind of like a big bucket of tax-free money anytime I want, no matter what the bankers are doing with their umbrellas. Okay. Second piece, it grows on a guaranteed basis every single year, no matter what the market does. So it's non-correlated. In other words, it's off that truck. It's quarantined from the market mayhem or who's in the White House or what they did in China last week or any of that. It just does the right thing, which is it becomes more valuable to me every year, guaranteed. Third piece, it is a form of estate planning because it automatically leaves my family more than I could ever save for them, guaranteed. That's how life insurance works. The only other way I could be more valuable to my family dead than alive is if I was a famous painter, which I am not. And then the last thing, and then I'll hush for a while, is when I have a whole life policy, there's a little feature in some life insurance contracts out there, Jim, and I had no clue about this until I went through my CFP and really dug into this. But there's a certain kind of whole life insurance out there where I can use the cash value as a line of credit to myself. It's almost like becoming my own banker. And when I borrow against the cash value of that policy, it will grow as if there is no loan against the policy. So I'll say that again.
Walk me through that again.
It's mind-boggling. Well, let's imagine for a minute, you got $100,000 in cash value. Now that's liquid, tax-free, guaranteed money, $100,000. And let's say I want to buy a car. I have a choice. I can either use an auto financing operation. I can use their financing shop down the street, GMAC. Somebody else's bank. Or I can pay cash. And now I've lost the growth of my $30,000 car that I just bought and drove off the lot. The car cost $30,000, but it really cost a lot more than that when you factor in the growth that $30,000 might have given me over my lifetime. Okay, so with me so far on those two things?
Gotcha. Let's go. So if I pay cash, I'm losing the ability to have interest on that money. So that's a cost.
There you go. So Jim, the only other way besides leasing, of course, which we could talk about, is using the whole life policy. And when you borrow against the whole life policy, if there's $100,000 of cash value in that whole life policy, and it's designed the bank on yourself way, when I borrow against that policy, $30,000 to go buy the car with cash, my policy will continue to grow as if I hadn't touched a dime of the money on the entire $100,000. And now I get my car, I'm driving it around town, and I still have uninterrupted compound growth on my cash value at the same time.
Because you're getting, is the loan, are you taking a loan against the $100,000 then?
Yep. It's a loan to the insurance company that I have co-ownership in.
Got it. Of that
So
money.
It's correct. Yeah. So there's a loan to the insurance company. And so I'm in control of the loan repayment. There's no required repayment plan to pay that off. I could take 2 years or 10 years or never pay it off. And Jim, if I never pay off the loan, the insurance company will deduct my loan from my death benefit when I pass away.
Got it. Very interesting. Okay.
So it's a non-recourse loan. Great, I believe, a great option because it overcomes that problem of opportunity cost. Every time I pay cash for something, I stop the growth. And every time I finance something, I'm under the thumb of another banker. But this lets us become our own source of financing.
So let me ask you this then. That $100,000 in that of cash value in that whole life is coming. Obviously, you put that $100,000 in there.
You may have put less or more in, depending on how far we are into the contract. But yes, you are the one. We're not using other people's, bank. We're using our bank. So the banker has to capitalize his or her bank. So yes, at some point you've been socking away cash into that policy. So it's definitely not, it's not without you being able to live within your means and save. Still comes back down to those principles. Yep.
Got it. So as you're, and this is the way, that, I mean, you could use this for anything. You use this for buying real estate, whatever you want, as long as you've got enough money in that account, right? So the starting point is having enough cash flow where you're starting to fund these things, right? So how did you get to that point where you started to do this?
It's really modest how small you could start, and it's kind of a good addiction in some ways. Randomly, I'll say, we started with 2 policies at a couple $100 a month each, one on me, one on my wife, and we did that we were overpaying on all of our student loan debt at the time. A couple $1,000 a month we were throwing on our student loans on top of the minimums, and so we just said, well, let's just lower down to the minimum what Sally Mae and her cronies were asking of us. And let's put what we were putting additionally over now into these new whole life policies. So our debts were still coming down slowly, and our cash value and our policies were rising rapidly because we designed the policy for massive cash accumulation, not death benefit. We didn't want commissions to the agents. We didn't want big fat death benefits. We wanted massive cash accumulation. So we engineered those policies to become super cash rich right from the start. So our cash values were growing quickly. Our debts were coming down. And at some point, they equaled each other. And so we took a loan from our policy and wiped out all of our debt. And our debt was gone. Student loans were paid off. And our policies were still earning interest and dividends on the full asset. So we didn't sacrifice our retirement.
Wow, that's pretty brilliant. So when you did that, I'm just curious, do you have to pay yourself interest, or, I mean, is that a requirement or no?
Yeah, great question. The insurance company, of course, will charge some interest. Since they're not a charity, they will charge some interest, of course, but they do not require that you pay it out of pocket. It will either just grow and accumulate alongside your cash value. And again, you are the owner of the insurance company you have a contract with. So it's almost like, let's pretend, Jim, you and I go into business together and we start a mortgage company together. Okay. And let's say I need a mortgage for some reason. Am I going to go to, mortgage company X down the street, or am I going to come to you and me, right? So I'm going to go to us. Now, Jim, I need a mortgage. Are you going to make sure that you charge me interest? Well, I hope so, right?
Yeah, I have to. We're in business here. This is a charity, right?
Yeah. So who benefits when I pay interest on my mortgage?
You both do.
Yeah. And that's how it works with these mutually owned life insurance companies. Now, there's publicly traded life insurance companies. I would not recommend you get a policy from not for this purpose. They're great public life insurance companies out there, MetLife, whatever. There's lots of good ones. But to do this whole banking function that we're talking about, to bank on yourself, you really want it to be a mutually owned life insurance company, which just means you and I are the only owners. There's no other, fat cats or public shareholders or whatever getting rich off this thing. It's just you and me and all the other policyholders.
Are those common? I mean, is that a common thing you can find in the marketplace?
Well, I can tell you that there's about 1,100 life insurance companies in the United States that I'm aware of. Mutual companies that have been around a century or more, that have paid dividends to their policyholders for over a century. 2 dozen, maybe 2 dozen.
Well, that's still a lot. I mean, it's shocking. That's a shocking big number to me.
Yeah. Most of them, even those, maybe half of those, I wouldn't want to really do much business or have a lifetime contract with.
Yeah.
But still, there's some really good ones out there. If you heard of Mass Mutual or another couple of companies, Security Mutual, Lafayette Life. These are just examples of really good mutual companies out there.
So on the so here's a question that I have as somebody that's an investor myself. Let's assume that I have $500,000 or $1 million in one of these policies, just as an example, and I have an option because I'm making money on that $1 million that's sitting there at some, I'm assuming, relatively low kind of number,
middle single digits.
4 or 5% or whatever, right? Or I have the opportunity to move that money into another vehicle, a real estate investment, where I can make 6-7% cap rate, let's just say. Why would I not do that? Explain it to me slow.
Yeah. Well, it's either or. with most financial products.
Right.
It's either or with most financial products.
Yeah.
Either it's in my savings account or it's in my drywall of my real estate deal.
Right.
Either or. But when I have a policy, a whole life policy that is collateralized by any loan, it's both and. So why would I not borrow from my policy and continue to get that whatever 5% modest return, good cash equivalent return, certainly better than my savings account or money market.
Yeah.
If I could get 5% in my policy, let's say, cases just sake of example, borrow against it to go buy my 6 cap.
Yep.
Now I've got 5 plus 6 with no additional market risk.
Got it. Okay. That makes sense.
Now there might be some policy loan interest that might shave 1% APR off that, but that's still a double-digit return for the same risk asset. You know, the real estate is going to do what it's going to do, and my policy is guaranteed to grow for me on a guaranteed basis. To me, this is how I do my real estate investing. It's how our clients do it. Why would I pay cash? Why would I do it with somebody else's bank? Now I can still use a bank for major deals, $100 million. I don't have that in my cash value. I just don't. So if I'm going to do a big commercial loan or something, I might use my policy for the down payment.
Right.
So let
me ask you this on how does, and maybe you don't answer this, but I'm sure you do, is how does a bank, let's assume that you had $100,000 in your account. You want to buy a property that's $900,000. Could you take that, get a cash loan against that policy for your down payment and then finance the balance? Is that a possibility?
That's how I've done it. Yes. You can, within about, the loan from the life insurance company is the easiest thing in the world. I can go online, click a few buttons. Here's the amount I want for my policy. Click. Here's what bank account I want it sent to. Click. And in about 5 business days, it's directly deposited into my bank account. 100 grand, 500 grand, whatever. I'll tell, I did this exact thing when I paid my taxes last year. I did this thing same exact process when I bought my house earlier last year. Had a really good friend of mine who financed the major marketing operation of her business, $500,000 that she borrowed from her policy. In about 5 days, it was directly deposited, no questions asked, into her bank account.
Wow.
And then, you're a cash buyer, or you bring that cash to closing for your real estate deal.
Right.
And then you finance the rest. If it's 900 grand, you get a regular bank loan. And by the way, I'll mention this and then I'll hush, I promise, Jim, but banks love seeing whole life cash value on your balance sheet. That's a very strong current asset. It's not like term insurance. Term insurance is just someday, maybe, hopefully a long time from now.
Right.
But whole life insurance, it's like having a CD, or or even better than a CD, because there's no penalties to get the money out of the policy. It's like having a big, fat, juicy savings account. Banks love it when they see cash value life insurance.
Wow. Okay. Really, really fascinating. This is something I haven't heard before, which is really good when we have somebody on. That's always teaching us something that's really interesting.
It was now, who is this not for, and what are the gotchas? Is it okay if I
walk us through for sure?
So I think it's great for business owners. I think I've already explained why. And for real estate agents and brokers, my goodness, if you were the only agent in your market that had something like this, and everyone else was begging a bank for money, you'd be the one picking up, the clients that others were losing at that point. But it's not a good fit for people who, one, need a super mega rate of return inside their policies. Jim, you already mentioned, these are not investments. These are savings equivalents. Think of them almost like a cash equivalent in your portfolio. It should not be every last dollar in your financial pyramid. You should put your solid, safe cash in here, because it's going to do, like I said, middle single digit returns. Now, those are after tax returns. After tax meaning tax free, but it's still a modest 4, 5, 6%. So if you're looking for 30% every year inside the policy, don't do this. If you're needing this to be instant and overnight, it does take some time to grow. There are some insurance costs. Even well-designed, super lean whole life policies still take a few years to break even. And I would say also that, if you are unable to save, if you're living beyond your means, it's not going to save you. Start with basic budgeting. Yeah, exactly, Jim. Yeah. So those are some, I'd say, those are kind of the missed expectations I see people have with these policies and when it's not a good fit.
Yeah. Yeah. Totally get it. So when you personally selected your company that you chose to use, was that a company that you had conversations with multiple companies, or you got a referral, or how did you choose the company that you ultimately chose?
Well, we are, as a financial firm and as a certified financial planner, I have to work in the best interest of my clients. So what we do first, I'll mention myself also, but for all of our clients, I always sit down and listen carefully to their goals, what they're trying to accomplish. And if this tool is not a good fit, we just table this one because we are a full financial firm and we can look at other options. There's plenty of other places to park your cash.
Sure.
But this tool, for me anyway, was really helpful, and for some of our clients as well. So for me, Jim, to answer your question, I looked at those couple dozen mutual companies. I knew that it needed to have a long list of characteristics. Like, I won't bore you with all the details, but it needed to be a mutual company. I wanted 100 years of dividends without fail.
Yeah.
I wanted to see how they went through the Great Depression, for example. I wanted to make sure that you could borrow against the policy and it would continue to grow. There's a great life insurance company. I'll not name their name, but they're from the Northwest. I'll just say that. Okay. And they have a direct loan, meaning when you borrow from the policy, it stops growing. Now, that's fine, I guess, but what good does that do me? How is that better than a savings account? So, I had a long list of criteria that we looked for, and happily we have about a dozen or so that I really think are quality for our clients and for myself as well.
Okay. So you gave me a list of questions that I could ask you, and a couple of them have really jumped out at me. One of them is this question, which is really interesting. It's, what's more important, rate of return or rate of income? What do you mean by that?
Yeah. Well, I'll tell you a story. A gentleman who's good doctor, making $250,000 a year, doing just fine. He was super pleased with his 8% in his mutual funds the last couple of years. Very pleased with that. In his inside his tax deferred 401k, he had a very high 7-figure balance inside his 401k, so he was feeling very good about himself. But as we started to have conversations, a few things happened. One, we looked at that return, and he didn't actually get an average rate of return of 8%. In fact, his change had almost not changed at all, except for his contributions. In other words, the only thing that was growing his 401k was him packing his own money in there. Now, how is it possible that the account statement said 8%, but how is it possible that he could have had no additional money growth, and yet they had advertised 8% on his statement? Let me kind of describe this with a little bit of fun mathemagic here, Jim. Okay. So let's say you invest with me, you give me $10,000 this year.
Yep.
And let's say I do phenomenal and I double your money. Okay. So your 10 grand went up by 100% to 20 grand.
Yep.
Okay. So now we're in year 2, and year 2 starts and I lose half your life savings. Boom. 20 grand drops back down to 10, negative 50%. You're back down to exactly where you started, right?
Right.
But if you do the math there, 100 minus 50 divided by 2 is your average rate of return. 25% is your average rate of return. And mutual funds are allowed to advertise average rates of return. And I would claim that average returns mean nothing.
Yeah.
So our doctor friend was floored when he saw that, because that was before his taxes were going to be due on the 401k. And when we got to talking, he believes that taxes are going to go higher in the future. Now, what sense does it make for you to put your money in a ticking tax time bomb? If you believe taxes are even going to be 1% higher in the future, why delay or defer that tax problem? So that was another big wake-up call for him. And finally, he had a 7-figure number. It was in the low 1 million somewhere. But for him, he needed a solid income to satisfy all of his expenses in retirement. So we looked at it, and he needed at least, after tax, he needed at least $100,000 of income after he retired. Mm-hmm. So back to your question about rate of return versus rate of income, the best research that retirement researchers have for what we should take out of a 401k or market-based account, the best research says we need to not take any more than about 3% of our money out of our retirement accounts every year. 3%.
After we retire?
After we retire. Yeah, your beginning balance on the day you retire, you have a 90% shot of success. It's only 9 out of 10 people succeed, I guess. But 90% says you won't run out of money if you take only and no more than 3% of your money out of your accounts every year. So what is that?
That's a very low number.
Pathetically inefficient, in my opinion. Yeah. So what is that? That means if you wanted $100,000 of money to come out of your accounts, you'd need 3% divided by 100,000. You'd need about $3.3 million after tax. So you'd need more than that. You probably need closer to 4 or 4.5 million in your 401k just to suck out $100,000 a year of income after tax.
Terrible.
To me, I feel like that's fully inefficient.
Yeah.
For where our
just not
Americans
attainable
are today.
For 99% of people are never going to get there.
99% are never going to get there. Jim, I haven't done the math here, but I wonder what you'd have to contribute to a 401k just to see it grow to 4 million whatever dollars. Oh. Can you even do that? I don't know. Maybe.
Not unless you're making a lot of money.
Yeah. So to me, I want to find things that do, it's like if you've ever played golf or if you ever, play a sport, you want to find the club that does what you're trying to do. If you're in the sand, you don't need to grab your putter. So what are the tools that help you best accomplish your goal? Mm-hmm. With these, again, to these whole life policies, instead of 3%, we can typically pull about 6% out every year tax-free. Mm-hmm. So 6% tax-free is like you only have to save half as much money after tax in a whole life policy that you'd have to get in a 401k. And there's other tools like real estate, rental real estate properties, great tool because you get depreciation, cost segregation, all the incredible tax benefits that come with real estate, and save for rent moratoriums that we're all going through right now. It's a great place to get some tax advantage income as well. So that's what I mean by rate of income, ROI, rather than, rate of investment or return on investment, ROI. It's much better to get a rate of income than a return on investment.
I love it. Great. You have given us a lot to think about here, Mark. I mean, incredible amount of information in a short, just the 45 minutes we've been together. Give us like, what would be your best piece of advice for someone that maybe is starting from scratch? They don't have, a 401k. They don't have, this whole life policy in place. And they're just saying, I'm just starting to do a little bit better in real estate than I have before. I'm anticipating having a pretty good year. What would that be like step one for wealth building moving forward?
Do you want a 90-second answer or more like a 3-minute answer? I'll do either one.
Do a 3-minute answer. Give me your.
Okay. All right.
Let's go deep.
I'll keep it three minutes or less for everybody. Okay. Because you've been very patient. I know I've been rambling.
No, good stuff.
So the best piece of advice in my, ignorant opinion is start with a question. Ask yourself, what do you want your money to do for you? Mm-hmm. Don't let that question slip by. Write it down. Find 15 minutes or 2 hours to answer at some point in the next 24 hours, or it'll be in your ear out the other. What do you want your money to do for you? Because where you put your money makes it do different things. That's such an obvious statement, but I never took the time to think about it. We got the day job. My wife got her day job, the salary job. We got sat down with that binder and signed here for your 401k. That was it. No critical thinking skills at all for us at that time. But by asking yourself, what characteristics do I want my money to have? Because the environment where you keep your money makes it act different. A hedge fund is different than a savings account. A 401k is different than a whole life policy designed the way we've been talking about. Mm-hmm. And it matters. If I have all my money trapped in my home equity and my 401k, like most Americans do, then when Corona number 2, God forbid, comes at us, or an opportunity to expand your business or to acquire a business comes down the pipe, or a real estate deal, if I've got all my money in my walls and my 401k, I can't do anything.
Yeah.
But if I've got all my money in a liquid, guaranteed, predictable, tax-free account, you better believe I'm going to be taking advantage and growing in the midst of those opportunities. So that's where I would say start, is ask yourself the question, and I can't answer it for you on a podcast, but you could answer it yourself. What do you want your money to do for you?
Love it. Great answer. Great answer. Mark, where can people make contact with you or reach out to you or learn more about what you're teaching?
We've got a lot of fun stuff happening. Our podcast is chock full, 100+ episodes. We've got a YouTube channel. We even just started a membership site where folks can engage and talk to other people who are doing the bank on yourself strategies that we talked about on this episode today. But it all comes down to one website you guys could check out if you want to go to lg.subscribemenow.com. lg.subscribemenow.com is where we kind of have everyone go check out, where you can learn and find us wherever we might be.
Love it. Thank you so much. And thanks for being on the program. Great information, Mark. Appreciate you being here, my friend.